I think the ECB is widely expected to cut rates. I think the decision itself should not be a market-moving event. I think what we're going to be looking for is for the tone of the press conference, whether the ECB, whether President Lagarde keeps the door open to further rate cuts down the road. I mean, the data has been fairly mixed over the last few weeks. You have pretty high inflation again last week. So, there's still a case for the ECB to be cautious and not to commit too much to what they're going to be doing next. We are looking for 2 more cuts, one in September, one in December. But look, we want to see more insight and more clarity on that. And we might not get that, but I think the market will be hoping to get more confirmation that we're going to have more cuts down the road this year.
Now, even if we get a cut today, we're still going to be looking at rates that are pretty high from a historical perspective for the Eurozone. So ultimately, what does this mean for European equities this year? We have seen a pretty good rally so far. Could this actually, not be such a positive for European equities just as yet?
Well, look, I think what we learned this year is that higher for longer is not necessarily a negative for the equity market as long as it comes with stronger growth. And this year, everybody's spending, in my view, way too much time talking about interest rate, somewhat forgetting that earnings are still the key driver of equity market, and earnings have been pretty strong, pretty resilient this year. So I think, what you want is the best of both worlds. You want, rates to go down a bit to ease concern about, the kind of, consequence of higher for longer rate on the economy. But, if your rates go down too much, I think that might be a sign of weakness in the economy, right? So ultimately, as long as there is some optionality where market believes central banks are more likely to cut rate and hike rates down the road, I think that would still keep the asymmetry positive for risk assets.
Talk to us about the different sectors. I mean, you put out a recent note suggesting that you're actually overweight on real estate. You cut some of the exposure to autos. Just guide us through what is the rationale behind this.
Sure. I mean, we've been fairly positive on market for some time now. We are still constructive on the market for the rest of the year. We just think the growth policy mix is pretty good. But within that, we want to start to look at sectors, stocks, part of the market that could really benefit from lower interest rate. It's going to be a slow process, but definitely you still have a very polarized equity market where quality, growth, the safe part of the market have done pretty well while rates were going higher. And on the other hand, you have the more, rate-sensitive part of the market. As you said, real estate is one, utilities, some of the longer duration sectors, which have been really challenged by higher for longer rates. So we do believe that, if we are moving towards this new monetary cycle where rates are going down, some of the losers from rising interest rate might become winners again, right? So that's what we've been doing in our allocation, trying to be a bit broader in terms of allocation and moving away from the pure cyclicals or growth winners.
What about European banks? Because obviously they benefited quite a lot since the ECB started that hiking cycle. But as we are gearing for a rate-cutting cycle, what is the outlook for the banking sector in Europe?
Look, I think short term, there may be a temptation from investors to take some profit on the banks. That's the best performer sector on the year. And obviously, the reason for that earnings have been very strong, and that's largely because rates have been, pushing up interest margins. Now, if rates go down, obviously, this story should be behind us. But in our view, banks need somewhat rates to go down. I know it's very counterintuitive, but we think rates have to go down a bit to alleviate some of the concern on growth, on the cycle, on credit quality, on the balance sheet of the banks, right? Again, what you want is rates to go down a bit to, open the door to more sustained expansion in Europe, but not too much, in order not to kind of hit margins too much. So, if rates go down a bit, we think this is something that banks can cope with as long as growth is recovering down the road and credit quality start to improve as well.